All right. Entrepreneurship students, we are in week 5 of 8. And this week, we got a couple things going on. One, we learned a new way to assess a market or evaluate a market, and that's cost of value delivery. You're going to be using this week in a project. So, I'll go over it really quickly, and then you guys will be using it. I'll show you in just a second. Then we have financial modeling. We have a new lesson this week and a new concept for you to learn, and it's called variable versus fixed expenses. And so I'm going to show you how to break those out. And then for your business, a lot of you still need to get in your competitive analysis, your business model canvas. And then this week, what we're going to do at the end of the week is you're going to do an activity called pivot or proceed. That means, we'll talk about what that means. All right, well, let's start with cost of value delivery. I'm going to go over this really quickly, so you won't get the full kind of understanding of this if you missed yesterday. Where is it? Here it is. So, we're looking at these 10 ways that you can evaluate any business, and one of them is called cost of value delivery. Think about that. A cost for delivering your value. So here's what it means. How much will you have to invest before you're ready to sell? How much will you have to invest in the company before you're ready to sell your products or services? So let's look at an example. Let's say that you wanted to start a home cleaning company. So you go into people's homes and you clean their homes. Awesome. How much will you need to invest for you to be able to do that? Now, we plotted on our scale of, 1 to 10. 10 being you have to invest a lot of money, like crazy amount of money before you can start selling. And 1 is basically no money. So where would you put this? Would you put it at a 3? Well, what are you going to need to invest in before you can sell your services? Not much, right? Gloves, a mop, some rags. So that's about it. So we're gonna rank this one really low, like a 2, because the cost of value delivery is low. Okay, what about this business? Let's say that you wanted to go out and mine gold out of our mountains in America. Pretty cool. You could maybe make a lot of money doing that. The question is, what is the cost of value delivery? In other words, how much do you need to invest in this business? How much money do you need to invest before you can start selling your products? And you're going to definitely need these giant excavators to be able to do this, at least, maybe more. And so each one of these costs like $100 million. No joke. I made that up, but like, let's say $3 million, $5 million. Well, we're going to put that way over here. The cost of value delivery is really high for this business. All right, so that's cost of value delivery. Again, it's a really important concept that we use when we're evaluating businesses. Hey guys, then we looked at financial modeling. Actually, I'm gonna skip this one. We're gonna do this one at the very end. So I'm gonna come back to this one here. Starting your business. Let's see. So the assignment last week was the business model canvas, and that looked like, let's see. Yeah, it was in week 4. Why can't I find? Oh, there it is. Okay. So so this was the business model canvas. You know, you have key partners, key activities, key resources, and you're kind of brainstorming your business out on this canvas. So that's what this is all about. It's a great way to brainstorm your company. So that was due last week. I didn't get very many of those in, so I'm going to be looking for you guys to get that in this week. Competitive analysis. So that is you going out and looking at 3 of your top competitors, and then uh, you know uh, analyzing them, taking some of what's working for them, avoiding what's not working for them. So that's a really important one. And then this week, at the end of the week, I want you to do this activity: pivot or proceed. So you're at this fork in the road. You've gained a lot of knowledge about your business idea. You've tested it. You've done a competitive analysis. Now you need to decide, do I pivot my company in some way? So do I change the idea in some way? Or do I proceed and go straight forward? You've gotten really good feedback. Everything's like working really nicely, so you just proceed. Okay, well, to do that, I want you to analyze your business. And so if you scroll down here, um, notice that I got this table where I got principles and then how you're going to rank your business idea based on these principles. And look, these principles are exactly the ones that you are know: urgency, market size, pricing potential, cost of to acquire new customers, cost of value delivery, uniqueness of offer. You know all of these. So what I'm asking is for you to do 3 things. I want you to assess your business idea on each of these variables. So, urgency. How urgent do people want your product or service right now? Is it a 2, so not very urgently? Or is it a 9? Oh my God, it's high urgency. You're going to write under the assess, you're going to write your assessment of why you think it's a 9 or a 2 or a 6. Then in the increase, you're going to come up with a couple ways for you to increase customer urgency for your business idea. So this could be, I don't know. You guys will be the brilliant people here to figure out how to increase customer urgency, market size, pricing potential. So I want you to rank yourself, and then assess the business, and then figure out 1 or 2 ways to increase, in this case, pricing potential, or in this case, decrease cost of to acquire a new customer. Is your cost really high to acquire new customers, or is it really low? Assess yourself, and then look. We want to decrease our customer acquisition costs, so we would figure out a couple ways to decrease your cost here. All right. So that is that. This is a big week. You've learned a lot. Now we're going to put that into action and decide whether we want to pivot or proceed. That's what all this is about. At the very bottom, you're going to choose one of these. Are you pivoting your idea, or are you going to proceed? You're going to underline one of these. Notice that it's color coded, so pink versus purple. If you go with pivot, I want you to fill out these two boxes. And if you go with proceed, I want you to fill out this box right here. And you'll see what I mean when you get there. So that's the assignment for the week. Based on your testing, based on your analysis, based on your customer or competitive analysis, you're going to decide whether you're going to pivot or proceed. All right, well, that's it for that. And get in your competitive analysis and your business model canvas. All right. Hey, let's get on to the fun one, which is our financial modeling. So I'm going to scroll down here, and we're going to take a look at what are we learning this week? What's new this week that we want to look at? So give me 1 second. All right. So business financials number 4, factoring in expenses. Last week, you started to factor in expenses. So with the gumball machine, you started looking at what are the expenses to run this business. And remember that expenses in our professional example here, we have our revenue up here, and then we have our expenses down here. And that looks like this. We know this, if we simplified it, it looks like this model: revenue, expenses, net profit. So we list our revenues, we list our expenses, and then we say revenue minus expenses equals net profit. So that's how you get to here. Well, we're going to complicate this a little bit. So now what we're going to do is we're going to break out our expenses into 2 types: variable expenses and fixed expenses. Now, notice that, hey, in total we had $500 worth of expenses, but we broke that out into variable expenses and fixed expenses, and that they add up to $500. So all we're doing is we're categorizing all of our expenses into 2 buckets. Are they variable or are they fixed? What are variable and fixed expenses? Variable expenses are costs that change with each sale. Cost that changes with each sale. And we'll look at some examples of this. So every time you make a sale, these costs are going to change. Okay, well, what about fixed expenses? Fixed expenses are costs that don't change with each sale. So they're fixed. And we're going to look at a couple examples of that. Let's imagine that you own you want to start a picture framing company. So here's picture frame. You're going to make these custom picture frames for customers. Okay, and you can see how it might look. You have this wood material, you got this awesome cardboard, and you start layering them together around an awesome picture, and you get a pretty cool result. And people are willing to spend a lot of money on this. So you have a shop, right? People come in and you have a wall full of materials, and people can choose, the materials that they want, and then you go off and you build their picture frame. Well, we did a brainstorming of what are some variable expenses of this company. What are the variable expenses? Remember, these are costs that change with each new sale. And yesterday, our classmates brainstormed 2 costs. One is the actual picture frame material. And that's obvious. That's this material right here. Every time I make a new sale, the cost for this material goes up. So that makes a lot of sense. And then the other one is credit card machine costs. So when people slide their credit card through, it typically costs you $3% of whatever their sales is. So that makes sense. That's a variable cost. Every time I make a new sale, my variable expense goes up here. Wow. Okay, well, what about fixed expenses? Remember that fixed expenses are costs that don't change with each sale. So your fixed expenses are the rent that you pay for this shop, the business insurance that you buy, your marketing, your utilities, so like your electricity and heating, and then your employee salaries. So these are examples of fixed expenses. In other words, if you sell 1 picture frame in a month, your rent is exactly the same. If you sell 5,000 picture frames in a month, your rent is exactly the same. That's an example of fixed expenses. So I gave an example here of some of the numbers, facts and assumptions that could come with a picture frame business. So we say average price per custom frame, $100. This is what you're going to charge customers on average for their picture frame. Number of frames that you think you're going to make per day, 8. Cost of the materials per frame. So to make this one frame, it's going to cost $8 in materials. Employee labor. You're thinking you're gonna pay someone $20 an hour to help you, and they're gonna work 8 hours a day. And then marketing expense. You figure you're gonna spend $25 a day in marketing expense, and then rent, $1,000 per month. So these are the facts and assumptions that you are going to try to build. Now, so you get those facts and assumptions into your spreadsheet. So, $8 per frame, $20 per hour for employee labor, $1,000, $1,000 per month in rent. And then you start building out your financial model. So check this out. You always start with your revenue up top. And so we got price of framing, $100 per frame. Number of frames per day, we said it was 8. And then total daily revenue is, obviously we say equals B5, which is here, times B6, which is here. That makes sense. You're charging $100, you're selling 8 of them, that's $800 in revenue. Okay, where things get really interesting is when we break out our expenses, which we're used to, right? Now what we're going to do is we're going to break out start with our variable expenses. And we said that a variable expense is, the framing materials. And so all I did here, notice that it's a calculated cell. All I did was take the number of sales that I'm going to make times the cost per frame. And what I get is $64. And then I put total. And if you had more of them, you'd list them under here. So if there were 2 or 3 of them, you'd list them. And then I say total variable expense per day, $64. I just set this one equal to here. Or I summed it, but there's only one, so it doesn't really make sense. But anyways, that's what it is. Notice if I sell 500, notice this variable expense goes way up to $4,000 because now it's 8 times 500. But let's put that back to 8. So $64. 8 times 8 equals 64. So that's my variable expense. What about my fixed expenses? See that I got marketing spend per day. We said $25. Rent per day is $33. And all I did was take 1,000 divided by 30. And I get $33 a day. And then employee labor. Well, we know we're taking $20 per hour times 8 because they're working 8 hours a day. And so I'm going to spend $160 on my employee per day. Now, if I total all that up, total fixed expenses per day, that's $218 a day in fixed expenses. Then all I got to do to get my total daily expenses is I say my total variable expense plus my total fixed expense. And that gives me total daily expenses. Ooh, and if we have total daily revenue, this should say total. If we have total daily revenue and total daily expenses, we can calculate total daily profit, which is simply total daily revenue minus total daily expenses. So B7 minus B19. And we get $517 a day. Now, watch what happens when let's say sales go through the roof, 250 sales a day. Notice that my variable expenses went up, but notice that my fixed expenses stayed the same. And notice that my total daily expense went up and my profit went way up too. So wait, guys, the power of this is that you're able to see how your expenses operate when you have different sales profiles. So if you have one sale per day, sure, your variable expenses go down, but your fixed expenses remain the same. And look, we're making negative profit. So you're losing money. So that's really interesting. So guys, this is what you're doing this week. The thing that you're doing is lawn mowing business. So you're going to start a lawn mowing business. Here are a bunch of facts and assumptions. So you'll charge your customers $25 per hour of work. You figure it'll take 2 hours per job. With driving time and a lunch break, you figure you can handle 3 jobs per day. So this is all revenue stuff here. So get this all into a spreadsheet, and then this will help you build out your revenue model. Okay, well, for expenses, it'll take 1 gallon of gas for the lawnmower. It'll take 1 gallon of gas per job for the lawnmower. It'll take 1 gallon of gas per job to drive to the different jobs. And remember, you have 3 different jobs. Assume that gas costs $2.15 per gallon. You will use 5 compost bags per job, and that's $1 a piece. And you plan for $15 per job to cover maintenance of your machines, and you'll spend $25 on marketing. Okay, so what I'm telling you is this. Given these assumptions, create a financial model that shows daily revenue, expenses, and profit. Break your expenses into variable and fixed expenses. And then I got some questions down here for you. So I got 2 Be Brilliants, and then the questions here. So that's it, guys. That's what I want. That's what we're working towards. We're working towards creating sophisticated revenue models that break out variable expenses from fixed expenses. Good luck. Reach out when you have questions, and I can't wait to see the great work that you do.